Welcome to Thoughts on the Market. I'm Andrew Sheets, head of corporate credit research at Morgan Stanley. Along with my colleagues bringing you a variety of perspectives, today I'll discuss how corporate balance sheets are in a better place to handle a potential growth slowdown. It's Friday, August 16th at 2 p.m. in London. Much of the volatility over the last several weeks has been centered around fears that excessively high interest rates from the Federal Reserve will now cause the U.S. economy to slow too quickly. Morgan Stanley's economists are more optimistic and believe that the data will hold up, leading the Fed to start a gradual rate-cutting cycle in September rather than a more radical course correction. Against this backdrop, good economic data is good for markets, and vice versa. But even though we remain optimistic at Morgan Stanley about a soft landing in the U.S. economy, our economists still expect growth to slow. How prepared are corporate balance sheets for that slowing? And how worried should we be that this could lead to higher rates of default? A good place to start is thinking about how optimistic companies were heading into any slowdown of the economy. Overconfidence is often the enemy of credit investors, as rose-tinted glasses can lead companies to make too many unwise acquisitions or investments funded with too much debt. Yet across a variety of metrics, this isn't what we see. Despite some of the lowest interest rates in human history, the level of debt to cash flow for U.S. and European companies has been pretty stable over the last 5 years. Excess capital held by banks remains historically high, and merger and acquisition activity, another key measure of corporate confidence, remains well below the long-run trend, even after a pickup this year, as my colleague Ariana Salvatore discussed on this program earlier in the week. So despite the strong recovery in the U.S. economy and the stock market over the last 4 years, many corporate boardrooms have remained cautious, a good thing when considering their financial risk. Where corporate debt did increase, it was often in places that we think could withstand it. Large cap technology and pharmaceutical issuers have taken out more debt over the last several years relative to history, but it's been a pretty modest amount from a pretty low historical starting point. The utility sector has also taken on more debt recently, but the stable nature of its business may make this easier to handle. While companies across the rating spectrum generally didn't increase their leverage over the last several years, they did take advantage of refinancing the debt they already had at historically low rates. And this is important for thinking about the stress that higher interest rates could eventually produce. The average maturity in the U.S. investment grade index is about 11 years. And that means that for many companies, potentially less than 1/10 of their overall debt resets to the current interest rate every year. That means companies may still have many years of enjoying the low interest rates of the past, and that helps smooth the adjustment to higher interest rates in the future. The lack of corporate confidence since COVID means that corporate balance sheets are generally in a better place if the economy potentially slows. But while this is helpful overall, it's important to note that it doesn't apply in all cases. We still see plenty of dispersion between winners and losers, driving divergence under the hood of the credit market. Even if balance sheets are stronger overall, there is plenty of opportunity to pick your spots. Thanks for listening. If you enjoy the show, please leave us a review wherever you listen and share thoughts on the market with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.